Silver 2026 forecast. Experts reveal $80, $110 plus targets after COMEX shock. If you're a silver stacker or investor, today's news could change your strategy entirely. The silver market has been rocked by a sudden COMEX shock that sent prices plunging sharply, triggering panic among traders and forcing retail and institutional investors to rethink their positions. Experts across the industry are now weighing in, offering a range of forecasts for silver's movement in 2026. Some see the dip as a temporary correction, while others predict a rapid rebound fueled by physical demand, supply shortages, and macroeconomic uncertainty. In this video, we break down everything you need to know, from the immediate price reaction to expert opinions, short-term trading strategies, long-term stacking opportunities, and key global factors that could determine whether silver stays near the $80 floor or pushes toward $110 plus in the coming months. Whether you're focused on futures, ETFs, or physical silver, this analysis provides actionable insights, helping you navigate volatility while staying ahead of institutional players. Stay tuned because understanding today's COMEX shock is critical for anyone holding silver, paper, or physical, and it may directly affect your wealth, investment decisions, and stacking strategy in 2026. By the end of this video, you'll have a comprehensive picture of what experts are predicting, how to position yourself, and what to watch in the days, weeks, and months ahead. The recent COMEX shock has left the silver market rattled, forcing an abrupt correction that caught many investors off guard. COMEX, the primary futures exchange for silver trading, raised margin requirements unexpectedly, compelling leveraged traders to either add additional capital or liquidate positions to meet these requirements. This rapid forced selling triggered an immediate 11% drop in silver prices, creating a chaotic environment across both paper and physical markets. The shock highlights the interconnectedness of futures markets, ETFs, and retail trading, as a single technical adjustment can cascade into a broad market reaction. While paper silver fell sharply due to margin calls and speculative liquidations, physical silver in some regions experienced high demand, demonstrating a divergence between tangible and paper markets. Understanding the mechanics of this shock is vital for investors, as it explains why sudden price movements often feel unpredictable. By reviewing historical patterns, such as margin-induced corrections and flash crashes, investors can recognize that while COMEX shocks may create short-term panic, they often open opportunities for both traders and long-term stackers. Today's COMEX event emphasizes the critical role exchanges play in influencing market liquidity, price discovery, and volatility, proving that technical rules and institutional actions can dramatically affect retail investors' positions overnight. Margins are the backbone of futures trading, acting as collateral to secure positions and protect the exchange from defaults. In silver trading, margin requirements set by CME dictate how much capital traders must maintain to hold long or short positions. The recent hike in silver margins was a risk management decision by the exchange, intended to prevent cascading failures during periods of extreme volatility. However, a sudden increase in margin requirements often forces leveraged traders to liquidate their positions immediately if they cannot provide additional collateral. This liquidation contributes to abrupt price swings, like the 11% silver drop seen today. Beyond futures traders, margin hikes indirectly affect ETFs, as these instruments track futures prices and react to forced selling, amplifying volatility. For retail investors, the implications are profound. Understanding margin mechanics helps anticipate potential liquidations, price dips, and rebounds. Moreover, margin hikes reveal how institutional rules and technical policies influence the market in ways that may appear chaotic to outsiders but are predictable when you grasp the underlying mechanisms. Recognizing this interplay allows investors to plan both short-term trading strategies and long-term stacking approaches, avoiding panic while capitalizing on market inefficiencies created by sudden margin adjustments. Following the COMEX margin hike, silver experienced a dramatic drop of approximately 11% within a few hours, a significant move for a traditionally stable, safe haven commodity. Such abrupt declines are usually triggered by forced liquidations, high leverage, and panic selling, compounded by market psychology. Retail investors faced margin calls and rushed to exit positions, while institutional traders were forced to unwind futures contracts, contributing to the steep decline. Historically, similar drops occurred during the 1980 Hunt Brothers episode and the 2025 flash crash, where paper markets overreacted to structural pressures. What made today unique was the divergence between paper and physical silver. While futures and ETFs plunged sharply, physical silver demand surged in certain regions, indicating real buying interest. Monitoring price charts, volume, and open interest is crucial for investors because these indicators reveal short-term opportunities and potential rebounds. Recognizing the pattern of panic selling followed by physical demand allows investors to strategically position themselves, whether looking to buy low or prepare for volatility. Understanding today's price reaction in the broader historical and technical context provides insights into where silver could head next, helping traders and stackers plan informed moves. Today's silver price movements underscore the growing divergence between physical silver and paper instruments like futures and ETFs. Physical silver, coins, bars, and deliverable bullion, is tangible and finite, whereas paper silver represents claims on the metal that can be created or liquidated instantly, amplifying market swings. During the recent 11% plunge, physical silver demand increased sharply, highlighting that savvy investors are taking advantage of temporarily depressed prices. Vault shortages at COMEX warehouses and global mints signal that physical supply is being withdrawn faster than it can be replenished, creating premium spikes in tangible silver markets. Meanwhile, paper silver reacted to technical margin changes, causing sharp drops in futures and ETFs. This divergence is a critical indicator. When paper markets collapse but physical demand rises, a short squeeze or rebound becomes more likely, offering strategic opportunities for those holding or acquiring tangible silver. Investors need to understand this dynamic because it determines how long-term physical holdings may appreciate even when paper prices fluctuate violently, ensuring informed stacking and trading decisions in 2026. Silver's trajectory isn't determined solely by COMEX activity. Global economic and political factors play a major role. A strong US dollar can depress silver prices, making the metal more expensive for foreign buyers. Conversely, rising industrial demand in China, India, and Europe creates upward pressure, especially as these regions absorb a significant portion of physical silver production. Geopolitical events, such as trade tensions, sanctions, or energy crises, also influence investor sentiment and speculative positioning. For example, recent Asian buying trends, combined with supply constraints in Western warehouses, create a dual effect. Prices may fall in paper markets, while premiums surge for physical silver. Central bank policies, interest rate changes, and inflation expectations further compound market volatility. Understanding the global context is vital for investors, as COMEX shocks do not occur in isolation. They interact with worldwide trends, shaping both short-term volatility and long-term market forecasts. Experts factor these global drivers into their $80, $110+ predictions, emphasizing that silver's path in 2026 will be influenced by a complex interplay of domestic and international forces. For traders focused on the short term, today's COMEX-induced silver plunge presents both challenges and opportunities. Leveraged positions are highly sensitive to margin changes, so traders must monitor stop-loss levels, open interest, and price charts closely to avoid forced liquidations. Volatility creates potential for swing trades, scalping strategies, and tactical entry points at temporarily depressed prices. Short-term traders should pay attention to technical signals such as volume spikes, reversal patterns, and vault movements, which can indicate an imminent recovery or further decline. Understanding the divergence between paper and physical markets allows traders to anticipate rebounds in silver futures or ETFs while watching premiums rise in tangible holdings. Discipline is key. Emotional reactions can lead to losses during rapid swings. By combining technical analysis with real-time market news, traders can position themselves to take advantage of the short-term price fluctuations without overexposing themselves to risk. For long-term investors and silver stackers, the COMEX shock may represent a strategic accumulation opportunity. Physical silver is in short supply, with vault withdrawals and increased premiums indicating strong real-world demand. Holding tangible silver acts as a hedge against systemic risks, currency devaluation, and future margin adjustments. Diversifying with gold or other precious metals can further mitigate risk. Long-term strategies involve gradual stacking, rather than attempting to time the exact bottom. Investors should monitor vault withdrawals, international buying trends, and macroeconomic indicators such as inflation, industrial demand, and central bank actions. The $80, $110+ target range suggested by experts highlights that, despite short-term volatility, physical silver may appreciate steadily over 2026, rewarding disciplined holders who prioritize tangible assets over speculative paper positions. Silver's price history provides valuable context for today's COMEX shock. The 1980 Hunt Brothers crisis demonstrated how leveraged positions and attempts to corner the market can trigger catastrophic collapses, while the 2025 flash crash showed the susceptibility of paper silver to margin adjustments and rapid liquidations. Today's 11% drop shares similarities with these events, highlighting the recurring pattern of forced selling, panic, and divergence between paper and physical markets. Historical analysis allows investors to anticipate recovery patterns and potential price floors, while recognizing how institutional policies, margin rules, and global macro factors can amplify market reactions. Understanding history ensures that investors approach volatility strategically, rather than reacting emotionally to sudden market shocks. Analysts and market strategists are weighing in on silver's 2026 outlook. While some predict consolidation around $80 as a short-term support, others anticipate a rebound toward $110 plus, driven by physical demand, vault shortages, and macroeconomic conditions. Experts also consider geopolitical tensions, U.S.-China trade dynamics, and central bank policies when assessing potential moves. The divergence between paper and physical silver is a recurring theme in their analysis, with forced liquidations creating temporary price dips that savvy investors can exploit. Forecasts are framed as ranges rather than exact numbers, emphasizing that volatility will continue to play a major role. By synthesizing expert opinions, viewers gain a comprehensive view of the market, helping them make informed decisions whether they focus on short-term trades or long-term stacking. The recent silver plunge highlights the crucial role of ETFs and futures in shaping market volatility. Leveraged traders forced to meet new COMEX margin requirements triggered massive liquidations, which cascaded across ETFs tracking silver futures. Open interest initially spiked as positions were closed or rolled, then dropped sharply as traders exited to limit losses. These paper instruments often magnify price movements compared to physical silver because they can be created or redeemed almost instantaneously. For investors, understanding the behavior of ETFs and futures is vital. Daily swings are often dictated by these instruments rather than physical supply-demand fundamentals. Retail and institutional participants alike must track these flows closely, as they provide clues to short-term reversals, accumulation trends, and potential squeezes. While paper markets are highly reactive, tangible silver responds more slowly, meaning that a disconnect often develops between futures prices and real-world bullion premiums. Recognizing this dynamic allows investors to position themselves effectively for both short-term trading and long-term stacking strategies. Today's COMEX shock serves as a stark reminder of the risks involved in short-term trading of leveraged silver positions. Sudden price swings, like the 11% drop, can trigger margin calls, forced liquidations, and rapid stop-loss executions. Short-term traders must remain disciplined, avoiding emotional decisions that amplify losses. Key strategies include monitoring open interest, volume spikes, and physical silver premiums as proxies for real market activity. Swing traders can capitalize on short-term rebounds if they recognize patterns of panic selling and forced exits. Scalpers may also find opportunities during heightened volatility, but these require precision and timing. Risk management tools such as stop-loss orders, hedging, and diversification across paper and physical holdings are essential. By understanding how institutional rules, margin hikes, and macro events intersect, traders can anticipate volatile moves rather than simply reacting to them, improving chances of profitable trades while limiting exposure to sudden shocks. For investors focused on long-term wealth preservation, today's COMEX margin hike and silver plunge could represent a golden opportunity to acquire physical silver. Vault shortages and surging premiums signal strong real-world demand, while paper silver reacts violently to technical changes. Gradual accumulation, rather than timing exact market bottoms, remains the recommended approach. Diversifying holdings across coins, bars, and other tangible forms ensures liquidity and security. Stacking physical silver also provides protection against systemic risks, currency depreciation, and inflationary pressures. Long-term investors should track global trends, such as industrial demand in China and India, central bank policies, and macroeconomic factors like interest rates and geopolitical tensions. By aligning their strategies with expert forecasts suggesting $80, $110 plus targets for 2026, investors can build a resilient portfolio capable of weathering volatility while taking advantage of supply-demand imbalances in physical markets. Analyzing silver's technical patterns provides essential insight into potential market moves. Following the COMEX shock, price charts show steep declines, volume surges, and open interest spikes, indicators of forced liquidations. Historical support levels around $80 suggest a floor, while resistance may appear near $110, $115 as physical demand increases. Patterns like short-term rebounds after margin-induced plunges or volatility clustering can signal potential swing opportunities. Moving averages, RSI, and MACD indicators help traders identify oversold or overbought conditions, while tracking premiums in physical silver provides a tangible measure of real-world demand. Combining technical analysis with market news allows investors to plan both short-term trades and long-term stacking decisions with more precision, reducing the likelihood of being caught off guard by sudden market shocks. Macro-level factors continue to influence silver's trajectory in 2026. A stronger U.S. dollar generally suppresses silver prices by making dollar-denominated commodities more expensive for foreign buyers. Conversely, global industrial demand, particularly from China, India, and Europe, exerts upward pressure. Inflationary expectations, interest rate trends, and central bank interventions also affect investor sentiment. Geopolitical tensions and trade disputes can amplify volatility, driving speculative positioning in both paper and physical silver. Experts include these macro variables in their $80, $110+ forecasts, highlighting that silver's movement cannot be understood in isolation from global economic conditions. Investors who monitor these macro drivers alongside COMEX activity can better anticipate price swings and make informed trading or stacking decisions. Historical patterns show that silver often rebounds sharply after sudden margin-induced plunges. Events like the 1980 Hunt Brothers crisis and the 2025 flash crash demonstrate how panic selling in paper markets can temporarily depress prices while physical demand continues. Following these shocks, prices historically recover, sometimes exceeding previous highs due to short squeezes, increased industrial consumption, and renewed investor confidence. Today's 11% plunge could trigger a similar recovery as forced liquidations stabilize and physical demand continues. By studying historical rebounds, investors can better time entry points for stacking and trading, ensuring they capitalize on market corrections rather than reacting fearfully to short-term chaos. One of the clearest indicators of market stress is the premium on physical silver. During the recent COMEX-induced plunge, premiums on coins and bars surged in regions with strong demand. Vault shortages in the U.S., Europe, and Asia indicate that physical silver is being withdrawn faster than new supply arrives. These premiums not only reflect tangible scarcity, but also provide a leading signal for potential rebounds in paper markets. For stackers and investors, monitoring premiums is essential. High premiums suggest that physical demand is strong even if futures prices are depressed, offering a strategic buying opportunity. Understanding the dynamics between paper and physical silver helps investors align their strategies with market realities, rather than relying solely on speculative futures movements. Global consumption and demand trends shape silver's long-term outlook. Industrial usage in electronics, solar panels, and medical devices continues to grow, especially in China and India, two of the largest silver-consuming regions. Central banks may also add silver to diversify reserves, particularly in volatile currency environments. Investment demand, particularly from ETFs and physical stackers, fluctuates with economic uncertainty and geopolitical tensions. Today's COMEX shock amplifies the impact of these trends, as physical silver demand surges despite paper market volatility. Investors who track global demand alongside domestic market activity gain a more complete picture of potential price trajectories, supporting both short-term trading and long-term accumulation strategies. Market experts have provided a range of forecasts for silver in 2026. Following the COMEX shock, many see $80 as a potential short-term floor, while medium-term rebounds could push prices toward $100, $110 or higher if physical demand continues and vault shortages persist. Analysts also caution that sudden regulatory changes, margin adjustments, or global economic shocks could create volatility. Divergence between paper and physical silver remains a recurring theme, with experts emphasizing that forced liquidations in paper markets may present buying opportunities for those holding tangible silver. Synthesizing these predictions allows investors to develop a roadmap for positioning themselves effectively in both short-term trading and long-term stacking. Today's COMEX shock and silver plunge illustrate the volatility and complexity of the market in 2026. Short-term traders must focus on risk management, technical analysis, and ETFs futures monitoring to capitalize on price swings safely. Long-term investors and stackers should view the recent drop as a strategic buying opportunity, particularly for physical silver, with growing premiums and vault shortages. Understanding the interplay between paper and physical silver, global macro factors, and historical price patterns provides a comprehensive toolkit for informed decision-making. Experts' $80, $110+ forecasts highlight both risk and opportunity, emphasizing that preparation, discipline, and awareness of market dynamics are essential. By combining short-term strategies with long-term accumulation, investors can protect their wealth exploit market inefficiencies, and position themselves advantageously for the remainder of 2026.